Better System Trader, episode 54.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, this is Andrew Swanscott here, and welcome to episode 54 of the Better System Trader podcast. It's so great to have you here again. Thanks for joining us. When I was preparing for the previous podcast episode on system trading through the Brexit, I had to review some of the past podcast episodes so that I could include some background content. And when I was going through some of those episodes, I realized that there was so much great information and content in those episodes and that I'd already forgotten about. I even found some concepts or ideas that at the time didn't really catch my interest because it wasn't appropriate to my trading at the time, but it's now more relevant to me personally. So I thought it might be time to do another review of some of the past episodes as a reminder and to perhaps gain or reinforce some past insights. So last year we did a podcast episode where we reviewed episodes 1 to 20. That was episode 30 if you'd like to go back and have a listen to that. So this time we'll go through episodes 21 to 40, and some of the topics or key points we'll be reviewing are how to never run out of trading ideas, the importance of creativity and a simple technique to increasing our creativity, how to manage data mining and avoid overfitting, a number of approaches to building more robust trading strategies, how to bet bigger with a smaller overall risk, and much more. So let's start with episode 21, which was with Tim Ray. I mentioned Tim in the last episode, so you'll probably remember that he trades more than 100 different strategies. So in the episode with Tim, we focused quite a lot on how he came to trade that many strategies and the various aspects on how to manage that many systems. So let's pick up the conversation where we're discussing how we actually came up with the ideas for that many trading strategies. Okay, and where do you get your ideas for all of these strategies?
I get them anywhere I can find them, really. I've been doing this for a long time, so if I find stuff that I can get, I'll collect it and sit on it, and I might look at it at the time, I might not. There's also stuff out there. There's books, there's magazines, websites. I do a little bit of collaboration with other people and things like that. So, there's myriads of ideas just out there. And so I use those as my initial starting concepts rather than sitting down with a blank piece of paper and saying, right, what's something I observe? Let's develop a system based on that. Because there's plenty of people that have gone before me. They're a lot smarter than me. And they're a lot better at maths than me. And so they've been able to give me a what I would call better starting point than me sitting down with a piece of paper and then trying to write that into code. So I start with an existing concept, even something simple like a breakout, and their way of calculating a breakout, and then move forward from there. And I can start adding to it my own things. I can say, well, what about trying this type of exit technique? And what if I make it a day trade system? And what if I use this stop? And so I can try all these different things. I can add a filter in or whatever,
So Tim's approach has been to take existing concepts and add his own twist to come up with something unique that gives him an edge. There is a lot of content available in books, websites, magazines, etc. So by taking those and mixing them with your own ideas, you should never run out of trading ideas to test. I actually have pages and pages of trading ideas to test just from doing this podcast. So there is plenty of material available out there to provide ideas. Our next guest is Robert Bobolowski, who founded a prop trading firm here in Melbourne. So we discussed prop trading in detail with Rob. Now, Rob also shared some of the common patterns or behaviours that he sees in successful traders and how those traders found an edge over others. So let's listen to Rob explaining what it takes. So this question's probably a little bit difficult to answer because it obviously depends on the person, but how long would it usually take for a prop trader to become profitable?
It is a difficult question. That is actually a really good question. We get asked that all the time. How long will it take me to become a successful trader? If you come and sit here every single day and continuously build models and test them and analyze them, and you're mentally fit, if you've got good models, and let's put it this way: if you think like everyone else, it might take you a lot longer because you're just going to continue to do the same thing as everyone else does, right? Or the 95% out there. But the ones that succeed pull the trigger. They keep on working on their models. They don't make excuses. They literally just keep on. They just keep on doing it. So if you do that day in and day out and just continuously moving forward, between 6 to 12 months is not an unreasonable ask. But if you excuse my upfrontness, if you fluff around and expect someone to, give you the answer every time, well, yeah, you're just like everyone else, and that's not going to work.
I really like the statement from Rob. If you think like everyone else, it might take you a lot longer because you're just going to continue to do the same thing as everyone else does, or the 95% out there. It's an interesting point, and one that was mirrored in episode 25 with Brett Steenbarger, where we discuss creativity and why it's so important to have unique trading ideas. So in that episode, Brett also shares tips to increasing our creativity. So let's take a listen. Right, so it sounds like you're saying that creativity is not just something that you're either born with or without, but there are actually steps that you can take to improve our creativity, like asking better questions.
That's a great point, that the research suggests that creativity can be learned. And I do believe that in successful mentoring, part of what's learned is that creative process. You learn to think like and see the world through the eyes of a successful mentor.
I've also noticed that, and I'm sure others have as well, that I often come up with ideas when I'm not even thinking about a specific task or problem. What's happening there, and can that be harnessed somehow?
Another great point that you make, and that is well documented in the psychological research on creativity. The way I think about it is that the successfully creative person spends a lot of time thinking about things, analyzing things, looking at different patterns and relationships of patterns, and they're looking into the different markets, what the markets are doing, and all of that is a process of analysis, getting inside of something. It's almost like looking at the world through a microscope and seeing detail. The creative insight, however, comes after that intensive immersion in data and observations. It's often when people step back, as you say, that they end up taking what they have analyzed and actually synthesizing it, putting it together into a new picture. And this is why so many of our insights will come at seemingly random times when we're taking a walk or taking a shower, because we are subconsciously synthesizing what we have been analyzing. We are taking the pieces of the puzzle that we have looked at through the microscope, and now we're looking through a telescope and we're seeing a bigger picture. If there isn't that intensive immersion in observations, there's nothing to synthesize. But also, if we keep our nose in the microscope, so to speak, we never zoom out and get that bigger picture. Creativity is a kind of 1-2 process of analyzing, seeing the pieces, and then stepping back and seeing a new, bigger picture.
So it sounds like also that there's a lifestyle impact on creativity. So you mentioned that, it can come to you when you're walking or when you're relaxing. What other things can we do to improve creativity through our lifestyle choices?
Well, it's interesting that you tie lifestyle choices to creativity. I think there's a merit to that observation. The synthesis part, seeing the bigger picture, really requires an open mind. And if you are constantly watching price action, or if you are working from one task to another task to another task, you never really have the kind of calm focus that seems to be helpful for generating that creative synthesis. That's why I think it's often during relatively unstructured free time that we come up with our insights. If we don't have that relatively unstructured free time, we clutter our minds and we never get to that point of assembling a larger picture. So there are techniques, even such as meditation, that help put us into a calm, focused state of mind where we're more likely to assemble the pieces of the puzzle.
That's interesting. I never really considered the importance of the synthesis step there. So that's great to highlight that.
Yes, and I think what happens is traders work hard but don't work smart. They do the analyzing. They're looking at charts. They're looking at data. They're just they got their nose right in the screen. They have their ears right in the conversations, and they're never stepping back and seeing a bigger picture or pattern. And as a result, they never see the world in new and different ways because they never achieve that creative synthesis.
So there were some really interesting insights from Brett on the importance of downtime. I'm sure we all realise that we need to take time away from the markets to reset, but it was interesting to hear that our brains actually need time to synthesise all the information that we've collected about the markets, and it's often during that unstructured free time that we come up with our insights. As Brett explained, creativity is the process of analysing the individual pieces in detail and then stepping back to see the bigger pictures. But if we never actually step back, then we're really missing out on a huge piece of potential there. Now, there are a lot of different ways to creating trading models, and the next guest I'd like to share is Michael Himmel, who uses artificial intelligence and machine learning trading models for his fund. In our chat with Michael, he highlights the importance of data selection for building robust strategies. So let's listen to Michael explain why that's so important. So what type of inputs are you giving this machine learning algorithm?
Everything from fundamental data on individual companies, right? Of course, all the price information that it can take, of all the indicators that it can possibly swallow, and also some non-structured data such as sentiment analysis. We let the computers make up their own minds about what they feel is the most important, what weights to attribute to which inputs. And of course, if they're unsuccessful, we kill them and we replace them with one that is successful. And that's the nature of artificial intelligence when you're using a genetic algorithm.
Yeah, okay. So how did you decide, or how did you come up with those inputs in the first place?
Well, they're all the ones that any human being would think of that had been in the markets for a long time. And this is another recurring theme from, I remember Andrea and Larry Williams and, any of the other, I would say, the pantheon of people that you've interviewed on your show here. It has to make sense, right? It has to be logical. Otherwise, you're just data mining. You're just finding relationships that may have been profitable in the past, but will never be profitable in the future. So we make absolutely certain that the computers are looking for and trolling amongst the data set that makes intuitive sense in the first place. And if it's not, first off, you have to be suspicious about it. And secondly, it probably won't do well in out-of-sample testing.
Michael really stressed the importance of selecting data that made logical sense. Now, I'm sure you've realised that we will often have conflicting information on this podcast. For example, one guest will say one thing and then another guest will say or use an approach that is the complete opposite. And that's actually one of the aspects I really enjoy about the podcast. It's hearing or considering other opinions that may or may not match my own, or maybe something that I haven't considered before. The next guest I would like to share is Michael Bryant, who has a very different opinion on building trading strategies. I actually received quite a few emails after I released this episode, so it provided some interesting debate on the strategy development process. Let's hear some more from Michael about his approach. Okay, now I think some people may be a little bit skeptical because I guess essentially you're removing an element of human logic by asking a computer to create these trading strategy conditions. So what would you say to that type of concern?
Yeah, I mean, I would say a couple things. First of all, who says the human logic is so great? I mean, people seriously. I mean, people like to impose a certain logic on the markets, but the markets are not based on logic. It's the accumulation of hundreds and thousands of participants doing all sorts of different things at the same time, and I mean, price behavior is a very complex time series, and the idea that you could just look at it and say, oh well, it's it's overbought, so I'm gonna sell here and whatever. I mean, people like to impose their own logic on the markets, but I think that's based on a faulty premise to begin with. And more importantly, I think the way most people build trading strategies kind of undercuts that, because even if they have a good premise, they end up distorting it with all the tweaks and modifications and optimizations that they do anyway. And so it ends up, whether they realize it or not, they've ended up engaging in this statistical process, except if they don't realize it, then they probably haven't done the corresponding validation test to make sure that their statistical process is valid. So I would prefer to let the computer do what it does, and then focus on the validation after the fact. And I don't really care that much about, what quote unquote logic it's using, as long as I can demonstrate that it's statistically valid. But there are limits. I mean, you don't want to do something stupid like compare a moving average of price to a time of day, for example. But within those basic constraints, it doesn't bother me if it uses moving averages in a unique way, or if it combines price patterns with something else, and you end up with something novel that you wouldn't have come up with on your own. Even if you can't superimpose some kind of meaning on that doesn't mean it's not valid.
So Michael's focus is more on the statistical validation of a strategy rather than the logic behind the rules. And whether or not you agree with this approach, he does raise a number of interesting points that I think are worth considering. Another guest that discussed strategy validation was David Aronson. He shared some really interesting insights into data mining, and I'd like to share with you one of my favourite points that he raised. It's actually something that I'd never really considered before until Dave mentioned it, so let's hear what he has to say. Okay, sure. Thanks, David. So I'd just like to move on to the topic of data mining. So in your book, Evidence-Based Technical Analysis, you discuss a few options to managing or measuring data mining bias, mainly Monte Carlo permutations and White's reality check. Now, since that book was published, I think maybe 10 years ago now, some aspects of trading system development and testing methods have changed. So are those approaches in your book still valid today?
Well, yeah. Let me start by saying that when you engage in data mining or predictive analytics, machine learning, whatever you want to call it, they all talk about it, refer to a similar topic. You're testing many different ideas and looking to pick a best. And whenever you do that, if you try enough things, obviously, if you try anything more than one thing, there's always going to be something that's a little bit better, or maybe even a lot better, based upon some criteria of merit, like profit factor or level of profitability or Sharpe ratio. So there's always going to be a best. The more things you try, the more opportunity there is for good luck to intrude. in that best. And so somebody who engages in data mining or curve fitting or something like that, and that's not, it's not a bad thing to do this. In fact, I think it's a very valid thing, but you have to be aware that there is this problem that when you pick a best from many attempts at developing a trading system or a predictive model, there's going to be a significant component of good luck in that best because you tried so many things, and perhaps the best really is superior, but it also may have benefited from a lot of good luck, and that's what allowed it to rise to the best of, let's say, 1,000 different things that you tried. So there's a need to correct for this so-called optimistic bias or data mining bias in the result of that best thing that you pick.
David goes on to share much more information on data mining and strategy validation. This was just a very small snippet, but the point I really found interesting was the contribution of luck in strategy results. By testing a number of different variations and choosing the best, there is a possibility that the results actually benefit from luck more than the strategy being superior. So I thought that was an interesting point to consider too. Now, our next guest, Robert Carver, has an entirely different approach to avoiding overfitting, and that is to do no fitting at all. That's right. He said no fitting at all. So when I first heard this, I laughed a bit, but I also thought, what does that actually mean? So let's listen to Rob explain. Thanks, Rob. So you've mentioned a couple of steps we can take to avoid overfitting. For example, the granularity of variations and the length of the test period. But are there any other steps that we can take to try and avoid overfitting?
I mean, a very easy way to avoid fitting is to do no fitting at all. And this always makes people laugh, but we kind of, as I said, most of the trading rules I'm using are kind of fairly well-known things. So they're trend following. They're things like carry. There's if you think about equities, then you've got things like momentum. You've got value factors. If you think about foreign exchange trading, again, you've got carry and trend factors. So these are all things that I kind of already know work.
Yeah.
So if I back test or fit them, all I'm going to do is validate that I haven't chosen things that are crazy. So the fitting process has almost no value unless you've managed to find a trading rule that is so absolutely appalling, and you've got enough data that you can actually say in a statistically significant way, yes, this rule is so bad it's not even worth thinking about including in your portfolio. So I think most people do far more fitting than they need to or should do. And I think that's because people believe that there's more alpha out there than there perhaps really is, and they just need to keep on fitting and keep on, polishing their trading rule until the Sharpe ratio is at the level where they think it should be. And I'm not completely sure that's the case. I think doing that you just end up with something that's probably overfitted. So that's the first thing you can do is not bother at all. Just in terms of general techniques, I mean, I'm a great believer in simplicity. Things like machine learning and big data are obviously very very popular nowadays. Don't get me wrong, if you're an expert in machine learning and you can analyze some financial data and come up with a trading rule and make money, that's fantastic. But I'm wary that people who are less experienced might be using some kind of fitting technique they don't really understand, and they don't really understand whether what they're doing is overfitting. It's sometimes, if it's the more complicated the inside of the black box is, the harder it is to know whether the black box is really doing the right thing or not. So I would personally use a technique that you are comfortable with and that you understand, and you that's kind of at the level of your experience and your skills. If you buy an off-the-shelf package and it has some amazing fitting technology inside it and you don't really understand what it's doing, then that's potentially a dangerous situation.
Mm-hmm.
Another thing that people don't generally do is use information from different markets to fit. I think too many people fit individually on each thing they're trading. So they might fit one model on Eurodollar, another on cable, another on crude oil futures. Now, this is only valid if it's really true that these things are so different that it makes sense to use a different trading rule. And if you actually look at the statistics, abstracting away from costs, because obviously all these things have different costs, but if you look at the pre-cost returns, it's pretty unusual to find firm evidence that a particular set of trading rules makes more sense on one instrument than another. So generally speaking, I would default to getting everything I'm trading and assuming they're all, I mean, if you're trading just commodity futures, then I would absolutely just fit them all together and use all the data you have, and essentially trade the same model, obviously counting the costs differently, but trade the same model for all of those things, because that way you're going to be getting a lot more data because you've got a lot more things to choose from, and you're less likely to be overfitting for each individual instrument.
Another guest that had an interesting approach to trading was Greg Morris, and he shared with us a concept he called weight of the evidence. He uses this technique in trend following, but it could also be applied to other trading styles as well. So let's jump over to Greg and listen to him explaining weight of the evidence.
Okay. All right. Thanks, Greg. Now, I'd just like to switch topics a little bit to a concept in your book, which I think could be very valuable for a lot of traders and investors, and that's the concept of weight of the evidence. Could you explain what that concept is?
Certainly. I stole that term from Stan Weinstein, who wrote a newsletter, starting in the 70s called The Professional Tape Reader. What it is, as a trend follower, we have a basket of indicators designed to measure price movements, designed to have breadth measure price movements, and another area is the relative strength of things like small cap versus large cap, growth versus value, et cetera, which is good in trend following as a confirmation indication more than a specific timing event. And so this weight of the evidence is let's say we have a dozen indicators that we like to measure the weight of the evidence, and they're all based on price and breadth and then a little bit on relative strength. And based on their performance in the past, we assign weights to each one of them, so that the sum, if all 12 of those indicators were saying we're in an uptrend, then the total would be 100. And if they were all saying we're not in an uptrend, it would be 0. So obviously, since they're looking at different things over different time frames, you'll have a number that goes between 0 and 100, and that's the weight of the evidence. And then you divide that weight of the evidence up into segments, say from 0 to 30, 30 to 60, and 60 to 100. And you do that with a lot of testing and past examination. And you set those zones, and so that those zones then control the buying requirements. I only deal with ETFs, what you can do with stocks also, but if you're in that lower zone, which means that less than 30% of your indicators are saying you're in an uptrend, then I want to have very rigid buying requirements. I want to buy ETFs that are already proven that they're rising, and again, using technical indicators to see that those ETFs are in an uptrend. And then I also, that zone tells me what the stop is, and the stops are going to be really tight down there in that lower zone. I have a saying that I know I'm going to be wrong at times, but I'm not going to stay wrong. And I think that's where a lot of people fail. They think they're right and the market's wrong, and that's a good way to find another job. Then as the trend matures, as the trend continues to build, you go up to the next zone, and that changes, that probably loosens the buying requirements, and it also loosens the stops a little bit. And then you get up in the top zone, which I call the green zone, and then pretty much everything is available to be bought, and the stops are at their loosest point. And so that's how that weight of the evidence. It's a fairly simple concept. It just requires a lot of discipline.
The next guest that I'd like to share is Andrew Gibbs, and he has a very different technique again to creating robust strategies, and that is to combine fundamental data with technical analysis. So let's hear a bit more from Andrew about how to do that. So some technical analysts may say that fundamentals don't matter because I guess price is the ultimate indicator of the value of a share. What would you say to that type of statement?
Well, I mean, there's merits to both approaches. So I guess it depends if someone was challenging me. I'd probably I'd probably say, well, technical analysis is really easy to curve fit and data mine, and your future results don't look anything like what the back tests look like. So what I found is that the fundamental systems tend to be quite robust. The performance tends to continue, and it tends to follow that same path that the back tests have followed. So whereas with technical analysis, I've been doing technical analysis and systems for a lot longer than I have the fundamental stuff, and quite a lot of the time the equity curve does go flat the moment you start trading a system, because you've actually mined the data, and it's quite surprising how easy it is to data mine. You don't actually have to do much. So technicals, you're limited to very, very simple systems, recurring patterns that happen a lot and only have a very small expectancy or edge. Whereas fundamentals, the concept is quite different. You've got a lot more data to operate from. You've got a lot more information to use, and the game changes. It's not about trying to pick the highs and the lows. It's about trying to pick those stocks that are going to do better than the average.
So I'm just thinking about that statement you made about how it's easy to data mine using technical analysis, but not so much for fundamentals. So,
well, it's probably easy for both, but yeah, well, I think there's a lot of academic research has gone into identifying edges using fundamental analysis, and you can certainly apply some of that to the markets, and just simple things like looking for value. It seems to work. You seem to get some outperformance, but even things like just equally weighting your portfolio as opposed to capital weighting the portfolio gives you outperformance, particularly in the US. So you can just use very simple conceptual things to begin with, and then just focus on stuff that makes a lot of sense. So, I mean, value is good. Buying good companies when they represent good value is an edge that you can use. Looking at low short interest is an edge. I mean, finding solid companies with high returns on equities and just ranking businesses using those concepts, you can actually say why you're buying something. Whereas technical analysis, it's very hard to put a finger on why you're actually doing something.
Let's switch tracks a little now and move from trading approaches to I guess you could call them trading components. And by components, I mean aspects like entries, exits, money management, etc. A lot of focus is put on entries, so let's hear what fund manager Thomas Stridsman thinks the most important aspect is and why. And so from the future, let's go back to the past. Throughout your years of trading system development, can you pinpoint a particular insight that really propelled your trading forward?
Yes. After having written my books, I hadn't really sort of internalized this knowledge at the time I was writing the books. It was just sort of there, but I finally now I realize the importance of money management. So entry exit doesn't mean much to me any longer. I use the most simple techniques and focus all my research on money management. I manage a rather small fund, and I'm basically the only researcher for the commodity portion. Yet over the years I've been active in this fund, I am either outperforming or doing just as well as the major players, such as Winton or Lynx here in Sweden, where I'm located. And I believe I'm doing that because I have focused my research on the correct area, which is, again, money management.
So Thomas uses really simple entry and exit techniques. Actually, I think at some stage during that interview, he said he uses the most basic entries and exits you can find on the internet, or perhaps it was in books or something. But anyway, his edge is money management, and so he focuses all of his research on money management instead of entries and exits. The next guest is Michael Cook, and Michael shared an idea with us to increase position size on certain types of trades to enhance performance. So let's go over to Michael now to find out a bit more about that approach. Okay, if we can just jump back a little bit now, back to your the statement you made about the contradiction between betting big to win big and betting small and identifying big moves. Now, you mentioned you were working on a possible solution for this in 2014. Did you come up with anything that you think works?
Yeah, I mean, conceptually, we all use, I think, it's pretty common to use a cash stop loss. Okay, fine, with futures trades. I use them. I don't like them being activated, but they're in as the final, the final catch rope on an aircraft carrier before the plane drops into the ocean. So, you always want to have one, but you don't really want that to be the stop that actually takes you out of trades. You want, far more market-related stops to get you out, because obviously the market couldn't care less what your pain threshold is. It's really neither here nor there. So where I was trying to go with this, as I sort of alluded to earlier, was, is there a way of packing more risk in by getting stops lower? Now, what I'm not talking about is just reducing your stop size by having a very small cash stop, for instance, because clearly that just gets you a lot more stop outs, and you do need room for markets to breathe, or for the inevitable noise. So take that to its logical extreme. If you had a one-tick loss, stop loss, then of course you'd have 100% losers. So that whole thing about running profits and cutting losses is true as far as it goes, but it doesn't go far enough to be particularly useful, other than an extremely general concept. So getting back to that, I thought, well, if you have various stop levels that you've already identified for other reasons, not for the reason that they're small, but for instance that are, let's take some very simple examples, market related. So for instance, a prior low in a long trade might be one, or a prior high. So you could have entries for a system whereby you expect an immediate move in the correct direction for whatever reason. And if not, then you've in effect negated your thesis on the spot. And say, let's take a common market. Let's take a crude, WTI. $1,000 a big figure. And so in your stop loss, which is market determined, could be anywhere from 20 cents to $1.50, say. So anywhere from $200 to $1,500, depending on the circumstance. Well, I thought about this and I thought, well, actually, there's a very simple solution to that. Just take the trades that have the, say, sub $300 stop loss and triple your size, and just ignore the others, even though they have positive expectancy and they're perfectly reasonable trades. Just solely, and in that way, you're still running the same risk level, but you've suddenly tripled your size. So, of course, your potential upside has massively increased. So, like I said, it's definitely not just reducing a stop loss. That's the highway to ruin. But what it is if you can market define stop points and then just take the trades whereby your stop level is much smaller, then you can ratchet up size. And size is what makes you the money. It's position sizing. Far more than the perfect entry, which is what everyone fixates on. So that would be one solution, and obviously various forms of options would be other solutions in that realm as well. But that's kind of what I mean about, you're still in effect you're betting big, but with a small overall risk level, which is the key.
Okay, so now before I start wrapping up this episode, I'd also like to briefly mention a number of other guests from episodes 21 to 40, which I haven't actually included so far. In episode 24, we were joined by trader coach Dr. Van Tharp to discuss beliefs and the impact they can have on trading. We also covered trading mistakes and overcoming fear, perfectionism, and impatience. In episode 27, our guest was Dr. Gary Dayton, who is a trader and a psychologist, and he shared why traditional approaches to controlling emotions don't work, the role of emotions in trading, and how mindfulness can improve trading performance. Alan Clement joined us in episode 29 to talk about rotational trading, alternatives to stop losses, measuring system health, dynamic position sizing, and anticipating trading signals. In episode 32 with Laurent Bernier, we had a detailed discussion on short selling, the importance of exits, and insights into bear markets. Episode 34, we had Jay Capel as a guest, and he was discussing seasonality and how that can be integrated into a trading model. Episode 37 was all about stops, and Cesar Alvarez shared the results of a quant study he completed on stops. That study uncovered some very surprising results, so I recommend you go and check that one out. And the final one in the list was episode 38, where Kevin Davey talks about the importance of trading goals, common mistakes traders make setting goals, and the best way to formulate good trading goals. So that's a good one to listen to as well. So that covers all the episodes from 21 to 40. I hope you found some value in reviewing these past episodes. I think there's definitely a lot of great information that has been shared by all of the guests we've had so far, and it can be easy to forget, so I hope you enjoyed this one. Next episode, we'll be back to the normal format of just one guest, so I look forward to sharing that with you. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.